Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. The Fed pivots. Is the recession canceled? And what does this mean for your money? Let's just get right into it. The Fed has officially paused. They started their interest rate raising campaign March 16, 2022, and it is officially done as of 2023, the June meeting. Now, does that mean they're officially done for the entire year? Not necessarily. Would I anticipate that they're probably done as inflation continues to come down? That's probably more likely unless we see a major spike in inflation where they're forced to raise interest rates. I definitely don't want to. That's going to cause a lot of pandemonium and unpredictability and unknowns in the markets. And markets hate unknowns, they hate uncertainty, and that's all that would bring is a lot of uncertainty to the markets. So they are probably not going to want to do that unless it's absolute necessity that they do so. So what does that all mean for your money now that they've stopped raising interest rates? Money supply is still going to be tight. Let's take a look at where that interest rates are as of right now. I've pulled up here a 30-year interest rate or mortgage, the fixed interest rates for mortgages, which is the 30-year fixed interest rate is tied to all interest rates because they all start from the Fed funds rate, which they're controlling right now, and they are done raising that Fed funds rate. That means that the 30-year, the 10-year Treasury, the 2-year Treasury, all of those are all tied together to that Fed funds rate, and they are now done doing that. But look at it. It's still remaining high even though they're done raising interest rates. They're going to keep it higher for a long period of time. That means interest rates are going to stay high for your houses. Interest rates are going to stay high for business loans. Interest rates are going to stay high for personal loans. Money supply is still going to be tight. They're still trying to strangle inflation, and they have to keep interest rates high for a long period of time to ensure that the battle against inflation is over and they've defeated the inflationary spiral that was taking place in 2021 and into the early parts of 2022. All right, so they're going to keep this high. So just expect getting money, getting a loan, receiving credit is going to be tight. Your credit card interest rates, they are going to remain high. They're not bringing those down. Now, over the course of this year, if the economy looks like it's kind of on the tipping point of heading into a recession, whether that's a mild recession, a more mid-range, or even a big one, a deep recession, look for interest rates to start to come down preemptively before the Fed starts to cut rates. The interest rate market, the bond market are all going to price these things in before they actually take place, and they could start pricing that in immediately. As soon as the first sign of weakness in the economy, and honestly, we do see a lot of signs of weakness, but they're being counterbalanced by signs of strength. Job market looks very strong, wages look strong, but we're starting to see the unemployment tick up. Earnings reports normally we have the large majority of companies do well in a strong economy. We're starting to see these smaller businesses take a punch. Consumer credit has been ticking up as well. So it's a mixed bag of signs of strength, mixed bag of weaknesses, and it's starting to shift to the negative side. And as that takes place, the market's going to start pricing that in preemptively. All right, so now let's move on to the stock market, where your money should have been since October of last year. Let's take a look at the tech stocks and how strong they've been this year. I mean, the tech market is nearly 40% year to date. All right, so as we go into the summer, as investors, if you have a lot of tech in your portfolios, maybe you want to ring the register on that and lock in some of those profits, because just because they stop raising interest rates, just because we have a report of a new bull market, doesn't mean the market's just going to keep going up, right? So lock in those profits. Seasonally, this is a good time to lock in those profits. And let's maybe move some money into places that you might have some opportunities. So let's go on to some areas of opportunity. Let's take a look at our first one, okay? First one is, where else? The bond market. Now that the Fed has stopped raising interest rates, bond prices can rise. Over the last year, the bond market, and I'm showing you the 20-year Treasury yield, Treasury bond. I mean, there's a 2-year, there's a 30-year, but this one's in the middle, right? 20-year Treasury is down 8.16% over the course of this year. And that's going into June of 2022. So over the last year, it's down really significantly. You can see from this chart here that it's starting to recover. Well, it was starting to recover, and then over the last month or so, it started to decline again, and that's because of the fear of inflation taking a hold and rising back up, and then the Fed having to raise interest rates again. So that's an area of opportunity. You have something down 8.16% comparatively to tech companies, and that's the Microsoft, Apple's, Google, Meta, so on, is up nearly 40%. So ring the register on one, find opportunities in the other. Here's another potential opportunity for you. Utilities. Utilities are generally a safety play, and they generally also offer a fairly attractive dividend depending on what company that you end up purchasing. So this is just the utility sector as a whole. So this is year to date. It's down 4.19% compared to the up nearly 40% tech companies. All right, a final one that we have here. Again, there's other ones that you can look into, maybe some other commodity positions. This is energy, so your energy stocks, your crude oil stocks, and that's down 3.63% for the year. All right, again, ringing the register, finding some opportunity that's down, and there you go. All right, so let's move on to the next phase here. What are we looking at? What are our plans throughout the summer going into the latter part of the year? All right, so let's take a look at the S&P 500 real fast here. So year to date, up 15.78%. Okay, so it's had a really solid first half of the year. Now let's talk about seasonality. Seasonality, summer months are usually down. Historically, the more than 50% of the time, and the reason for that is investors, traders, they're out on vacations. The volume slows down in the markets. So seasonally, the summer months are usually down times for the stock market. Not for the whole stock market. As you can just see, I just showed you 4 different sectors, and they're all doing different things. The tech's going up nearly 40%, energy down, utilities down, the bond market down, so they're not all going to be doing the same thing at certain periods of time. So when I'm saying the stock market, I'm specifically talking about growth companies, your S&P 500 companies. Those tend to be negative in the summer, but there's rotation opportunities for you. There's opportunities for you to make money while stocks go down if you position yourselves in the right sectors. And this is no guarantee, obviously, but that's some potential opportunity for you to consider. And again, do your due diligence on your own companies that you're going to invest in. This is just what we're doing. Obviously, there's much more to it when we go and look under the hood of these companies when we're making our investment decisions for ourselves and for our clientele. Now, going into after the summer, going into that third and fourth quarter time frame, that's when stocks generally rush into another rally mode, heading into the holidays. People spend a lot of money for gifts, and stocks tend to do well. But we do have an anomaly going on, and the anomaly is what we see every 2 years, another election coming up. So what happens during that is all politics, and we're going to have to just pay attention to what's happening in the monetary, what's going on monetarily in our economy. What are they doing? Are they raising rates more? Are they printing more money? We'll have to pay attention to it. When politics are involved, it's all up in the air. It's whatever way the political wind's going, and we just have to recognize and then be flexible with our investment decisions, especially right now because there are still all kinds of storm clouds around us. I have a feeling we're going to start hearing towards the latter part of the year that the recession is no longer happening, the recession is canceled, and that's going to be a real warning sign for you when we start hearing that, and if we're still seeing all those storm clouds. So stay with us. We'll talk about those storm clouds. We're talking about what we're going to do next on Friday. we'll do another market forecast video for you. So if you like this content and you get value out of that, do me a favor. Like and subscribe to the channel, stay informed, and figure out how you can take this knowledge and make actionable investment steps. Expertise you deserve, experience you can count on. Thank you.